What's up, traders? Anthony Crudele here, and welcome to this week's episode of Develop Your Edge. Man, I am pumped for today's show. We have on Annie Duke. I love her books. So without further ado, let's get Annie on the line. Annie, thank you so much for joining me today.
Thanks for having me.
I'm really excited that you came on the show today. I know we're going to talk about your book. Before we get into your book, you got a really cool story that back in 2002, you were possibly going to be on the trading floor the same time I was on the trading floor back in Chicago. Share with everybody that story.
Okay, well, I don't know how great a story it is, but uh, in 2002, people who watch poker may recall that this was just as they started filming poker. So before it, the kind of some of the shows that they were airing were on air, I was in discussions to start trading in Chicago on the floor. And I was really far down the road on that. Like I was going to go take that job. And then poker kind of exploded all over television. And I just took a step back and I said, wait a minute, like I can always come back to that. Let me just see how this poker on TV thing goes. So like there was this fork in the road and I was like right on the precipice of going and trading instead. I have no idea if I would have been any good at it, but I was kind of heading in that direction.
I have no doubt you would have been really good at it. And let's jump right into it today because I've got a lot of questions about your book, How to Decide. And I think for traders, decision making is like that's what we do, right? Traders, every day we could put together a plan, but we've got to go ahead and make a decision. And one of the key things that you talk about in your book is decide fast, decide slow. And to me, when I was reading those notes about it, I was thinking to myself, I'm like, this is very much when everybody on Twitter or traders say, be patient. And I always say, yeah, be patient, know what you're looking for, but you've also got to be impatient at times. So talk to us about that mindset of like decide fast and decide slow.
Yeah, so the thing that you want to do when you're making decisions is you want to figure out when can you go fast and when should you slow down. So that's kind of the first piece of the puzzle. And then you want to make what's called a category decision about that. That if it's the type of decision that you should actually be taking a little bit of time with, you will always take a little bit of time with it. And if it's the type of decision that you can go fast with, basically you should be going faster, sort of up to the limits of time that you have. The reason why it's really important to not always take your time is because opportunities go away. So when you wait, that is costing you something. And we don't want the opportunities to expire. And the other thing is you have a limited amount of time to actually make decisions. So slowing down decreases the number of things that you can do because you're taking more time deciding about the things that you are. Really simple way to get to when can I go really fast. Really, a lot has to do with kind of liquidity, number one, which is just how easy is it to exit. And there's a couple of easy ways to exit things. One is that you could sell the position, and the other is that you, even if you can't get out of the position, there would be a really obvious hedge where you could actually hedge against it. So that's another way, obviously, to get off the position because you can neutralize it. The more that that's available to you, the faster you can go. The other thing is that we know when you can make a whole basket of decisions that you think that you're probably going to be positive expectancy at, you don't need to take as long to figure out exactly what your expectation is for any one of those decisions. So that would generally be if you can trade a whole bunch of things at once, where across those things you think you're positive expectancy, you don't have to take as much time with any individual decision that you might make because you're mitigating, obviously, the downside, you're mitigating your risk.
Right away, my thoughts are preparation. Preparation is key. And not only for a strategy, but mental preparation. For me, meditation has been huge for me in this because I'm somebody who wants it now. I want it now. I want it today. I'm somebody I love to trade. I'm an over trader by nature. And even if I walk into a store, I see something I like, I buy it. And over time, meditation has allowed me to calm myself down. So this way I know through my preparation when to decide fast and when to decide slow. Talk to us about getting to that point of being able to just be mentally in control to be able to do that.
Well, I think what you want to do is start to really start to think about the ways that your decisions might go wrong.
Yeah.
right? So you just mentioned there's two ways that you could go wrong. You could be an overtrader. You could have a tendency to invest too often, or you could be under allocating, right? You could be
Yes.
making too few decisions. And both of those are really problems. So one of the things I like to do is start to do some of these exercises where you're kind of thinking negatively. In other words, not thinking you will fail, but thinking about what are the ways that I might fail. And a game that's really good to play for something like over trading is called the Dr. Evil game. And the Dr. Evil game goes like this. If Dr. Evil had control of your brain, and he was going to make you make decisions that were for sure going to cause you to fail, what are those decisions that he would make you make? Except that there's a catch. And the catch is that Dr. Evil is pretty smart. So he needs to make sure that it's not something that's easy for you to see. How's he going to do that? That any individual decision in that category you could probably justify pretty easily. So we can see how you can get to over trading then as an issue. For any individual trade that you might make, it's pretty easy to justify. If someone asks you about it, you probably have a good reason why you thought it was a good choice. If you're even thinking about it for yourself, it's probably pretty easy to rationalize it, but you can only see it in the aggregate, right?
Mm.
Once you sort of see across, ooh, I'm making, a lot more trades than what my base rate should probably be. So it's something you can only see in the aggregate. A simple example would be like if I want to lose weight, it's easy for me to justify eating birthday cake at my child's birthday. And then it's easy for me to, justify, well, I went on a date and so I ate popcorn because I wanted to share with my date. And it's easy. And you can see how these little things add up and you start to accrue those losses, but it happens over time. So when you do that, and you can see how that would be true for under trading as well, right? So
Yes.
figure out what that weakness is where you're going to be able to justify any individual decision, but in the aggregate, it's going to be bad. And then elevate those and say, when I have those borderline cases, those are things that after the fact, I must take more time with. I must actually start to think and hold myself accountable and look for those patterns because now I recognize them. So you have to hold yourself accountable. And then the other thing that you can do is make what's called a category decision. You can look across what are those cases that I tend to sort of regret having traded in retrospect because I realized it was just taking on a little bit too much risk, and just cut those cases out of the situation, right? So you can just say in those cases, like I'm not gonna trade those like last 5% of my choices, right? And you can't do
Yes.
that. It's a little bit like saying I'm a vegan, so then I don't have to make choices about meat or dairy because I've already sort of decided that in advance.
This brings me back to just meditation, and to me, I think that the ultimate edge that I have been working on and will constantly working on is self-awareness in those moments, right? Understanding the moment and being able to actually slow things down, but actually decide fast and actually be able to slow things down in that exact moment and be able to decide slow. And that's just something that, look at, we all have to constantly work on. And it's something else we always have to work on as traders. And getting back to the book, How to Decide, is dismantling that hidden bias. Man, is this tough. I could do all the homework in the world. And I actually had a week like this not too long ago where I did everything right in my homework. And when I got to the market, it was like everything that I wanted to happen and thought would happen did. And I lost money. And I'm thinking to myself, what am I doing here? And it was just because I had some underlying biases of like, okay, this move's going to extend. I was long cold. I was pressing it into the highs instead of covering it at my area. I can go on and on about the mistakes I made, but because I had that hidden bias, it hurt me. Even though I was right in my trading, my execution was not good. Talk to us about dismantling, how you dismantle that hidden bias.
Oh my gosh. So yeah, I mean, that's really like that's kind of the whole book is kind of trying to get to that. And that this is what you just said. Like you can have a really good process. You can understand how to think about what are you investing in, what are the possible outcomes, what are the probabilities. You can calculate out what your expected value is. You can figure out what your downside exposure is, all of that stuff. But if the beliefs that are sort of informing that process have some sort of flaws to them, we're going to be in really big trouble. It's kind of junk in, junk out. And this is where the cognitive bias problem happens, is that it's really hard for us to fix those cracks in our beliefs, the things that aren't quite right that we think are true, but it turns out they're really just kind of supporting the things that we want to be true. So the main bias that's really, really problematic, particularly in something like trading, is that because there's luck involved, we will reason about what we believe to be true about the world in a way that confirms the thing that we already believe to be true. So if we think that a certain strategy is going to work, the way that we're going to look at the world is going to be looking at that and saying, sort of like looking at all the pieces of information and kind of fitting it to our model, as opposed to changing our model to fit the new information. And once you add volatility into the equation, it becomes really problematic in the short run because you could have lost because of bad luck. So now this becomes really bad, right? Because it's like when you win, you're more likely to say, well, I won because I was so smart and my model was so great and I'm such a great trader and look at how smart I am. And when you lose, it's like, can you believe that? I can't believe the market moved that way. Who could have known? That was really unlucky, and you sort of stick to your model. So the best way to actually address that is to get input from other people, but to ask other people in a very particular way. So I'll give you an example from poker because I'm sure that it will relate, right? If I'm trying to talk about a trade that I made in poker with somebody, the tendency would be for me to say to you, like, Anthony, let me ask you about this poker hand. Uh, Somebody raised in front of me, and I would tell you all the details about them, just like I would tell you all the details about the instrument I was trading and, what the market was doing and so on and so forth. So I tell you, like, are they tight? Are they loose? How have they been playing it? But they were winning or losing? How many chips do we have? All the facts that you need. And the usual way that I would do it is this person raised in front of me, and I looked down at ace queen. I was right next to them, and I raised back. What do you think of that choice? Right. So I tell you what the thing was that I chose to do. Um, but now what I've done is I've already given you the conclusion. So when you give me advice back now, it's going to tend to be to support the thing that I did. It's much less likely that I'm going to get your actual opinion of what I was supposed to do. If instead I say this person raised in front of me and I look down at ace queen, what do you think I should have done? Oh. Now I get to get your actual opinion. And honestly,
Yes.
It's really hard to discipline bias without doing that. So you can imagine in your situation, you can say, I made this trade, the market did this. What do you think my response should have been? Even though you already made your response, even though you already knew what you did, but nobody, like people just don't talk this way. They'll like tell you the whole arc of their day. They'll tell you what their, at the end of the day, what their P&L looked like. And then they'll ask for somebody to go back and help them. But that help becomes much less useful because you kind of pull them into your biases.
Yes. No, I love that. I mean, one thing that you said that I remember from reading in the book is luck. And you talked about how, and I'm sure you're going to correct me if I'm saying this wrong, but like, how do you account for luck? I think about myself and my experience as a trader developing my strategy. And it was like, oh, wow, today everything went great. And obviously the next day it could be different. And then, all of a sudden I have a day where it didn't go so well. And I'm like, really nothing changed. Was I just lucky that day? Like, how do you account for that, right? Because, and I always say, and everybody knows this, I think that, everything works sometimes, nothing works all the time. And you have this kind of luck involved in your execution of your strategy. And I remember you talked about this, like how to kind of account for it, and talk to us a little bit about that aspect that you discuss in the book.
Yeah. So basically, I mean, it's really hard because when we're looking at outcomes, the outcomes that really matter in the aggregate, right? Like we really care about like large ends.
Yeah.
But we're trying to figure out and learn from experience by small ends, right? Like we look at a trade and we won or lost. We look at a day, we won or lost. And we're sort of trying to work backwards from that to sort of what are our models good, are our decisions good? And that's really hard when you're living in a really high vol environment because we know that you can make a perfectly good trade and lose, and you can make a perfectly terrible trade and still win.
Exactly.
Right. So So basically, there's kind of two patterns. One is that when you're evaluating kind of like other people, you'll tend to do this thing called resulting, which is if they win, they're good. If they lose, they're bad. So, but that we know that that's not necessarily true. And then when it comes to ourselves, sometimes we'll do that pattern. But another thing we'll do is we'll say when we win, we're good. And when we lose, we're unlucky. So
Yes.
we get these kind of patterns. So and the patterns will differ. Like some people have different patterns, but we tend to only choose um, two relationships out of the four possible. So there's four possible relationships. I made a good decision and I got a great outcome. Let's call that an earned reward. I made a good decision and I got a bad outcome. Let's call that bad luck. I made a bad decision and I got a good outcome. Let's call that good luck. And I made a bad decision and I got a bad outcome. Let's call that my just desserts. Okay. So we know that all four of these things are going to happen, but depending on kind of your style and who are you thinking about somebody else's results? Are you thinking about your own results? Are you thinking about somebody that you traded directly against? You'll get some different patterns. But what ends up happening if we take, for example, the pattern that a lot of people have when they're thinking about their own life is I made a good decision. I got a good outcome. I got a good outcome. It must have been a good decision. I got a bad outcome. It must have been bad luck. Right. So we can see how we're going to learn a lot of bad lessons from that. So how do we kind of undo that? Right. Well, whenever you're examining how things go, you have to really think about which box is that fitting in because all four boxes are going to be equally populated. And one of the best ways to do that is to not think about the result that you actually got, but to think about all the other results that you could have gotten,
Hmm.
right? So uh, really map out when I made that decision and I chose to trade that, or that particular investment, what are the different ways that it could have turned out? And then go back and try to reconstruct what do I think the likelihood of those things were? And what do I think the payoff for it was so I can figure out what the expectation was. Then take the time. So now I can sort of figure out was I positive expectancy or negative expectancy? And when I was thinking about the amount that I was trading, was I properly taking into account the volatility what my risk was, right? So now you can sort of figure out like which box is it supposed to go in, and then you can do something even better than that, which is to look at your wins and train yourself to think if there was a better way. Because one of the big problems that we have is that when we're winning, we just go like this. Oh, I'm so happy. Look at how great I am. But what you want to do is say, look, it may be that I made a good decision, but I actually want to map out what the possible outcomes were anyway, because I might have chosen a secondary choice and I always want to choose the primary line. And I think that that's the best thing that a trader can do is to we all mull over our bad results. What we don't really mull over is our good results. The bad results we sort of think about it and we say why and you're trying to sort of undo it and how could I make it different in the future. Nobody looks at their good results and say, well, why, let me think about it, how could I make it better in the future? Because then it's like you're giving up credit for the win, but you're not. You're saying it's great,
Yes.
I won, I'm really happy, but what I care about is the next decision I'm going to have to make. So let me try to figure out if I was on a secondary line or a tertiary line, which may have been positive expectancy, but maybe I can get even more out of it. And that's going to start training your mind to really think about those four quadrants and to start sort of getting out of those habits of just kind of automatically deciding what good and bad outcomes mean.
I love that. I mean, I always go back to my career because that's all I can really talk about. And just thinking back to when I was looking at my results, and I mean, I think with losers, first of all, a lot of us as traders, we'll dwell on them, right? They stick to the back of our mind. We make money, we go out, maybe we go spend money, we go do something positive just to reinforce that the good thing that we did. And something that I did, and I want to hear what you think about what I did, was I kind of changed my thinking a little bit. When I started to do well, I just kept doing more of it. And I was really focused on where I was mentally, what was happening in my life. And I started journaling more about myself than about what I was doing in the trades. and I wouldn't spend any money. I would save money. And then when I started to do bad, I would take time off and I'd spend money. And I would kind of reflect on where I was mentally on both the good run and then how I got off on the bad run. I actually tweeted about this not too long ago, and I actually talked about it with you just a few moments ago, where it was like I was just off and I just didn't have good rhythm. And it was just weird because when I went back to that day, when I was done with that day, I was working out just in my own way. It was because I didn't get enough sleep. I came in and I just, I was just anxious for a result. And it was like my preparation couldn't have been better, but where I was mentally was wrong. And it was like, okay, the next day I got myself right back into rhythm. I just got myself mentally back in a clear place. So I'm just curious, like what you think about what I did kind of in my journey on that.
So, I mean, I think that that goes back to that idea of really thinking about separate and apart from the decision process. What are the ways in which my decisions might go wrong?
Yeah.
So, uh, so as a, sort of what you're talking about, right? And I remember this from poker. Let's say that I was sick, right? I was like coming down with a cold. It's really easy to convince yourself, well, those players aren't very good, so I should still play anyway because I want to get in my hours and I want to make sure I'm getting my churn and I'm going to go play. And I have to say, like, that never really worked out well for me, right? Because you're just giving up that little bit every single decision that you make because you just don't feel good.
Yeah.
And obviously that's going to accrue, right? So if you can sort of think about, like, again, going back to that Dr. Evil game, you can now start to think, what are the things that undo do my decisions where it's going to be really hard to spot, because I can justify to you why I played with a cold, because I can tell you how bad the game was, right? I can say, oh, but it was like really bad players, and so of course I did it. And so the more that we can identify, like, if I don't get this amount of sleep, if I haven't gotten my workout in, if I was rushed out the door and I didn't get to eat, if I'm feeling some sort of pressure at home that's sort of external to the decisions that I'm making, all of these things, and you can just basically make category decisions around those, right? When I'm sick, I will not play.
Yes.
I'm not going to trade. The other thing is that I think that we don't really pay attention to how tired we are matters. So I know in poker, I eventually tried to make a rule that, like, after 6 hours I was going to quit, no matter how alert I felt like I was. Because the big problem that we all have is, and the reason that you want to make these decisions in advance and just sort of set these boundaries for yourself, that's why I think loss limits are actually really good. Um, is that we in the moment are not really good at figuring out if we're our best selves. We're really good at rationalizing in the moment why it's just been bad luck, or why
So
we have
true.
such a huge edge on the next trade. We're supposed to just go for it. And so in the moment, we're actually quite irrational about those things. So if I felt like I were a perfect assessor of when I was had positive expectancy, I would never put a loss limit in. It makes no sense to have a loss limit if I'm a perfect assessor of my own edge. But the problem is that we're not perfect assessors of our own edge. And the times when we're really bad at that in particular is when we're losing, when we've had a bad streak, or when we're tired, or when we're sick. And all of those things really, when we're emotional about other stuff. And if you can't assess your own edge, then you just need to set limits that are external to that. And that's the thing, because
Exactly.
we're not robots, we're not AIs, and you have to include sort of the human thing. And I used to talk to people in poker who said, well, I'll lose as much as however, because if I think I'm better than the game, I don't really care. And I said, but the problem is that once you've lost a certain amount, you're not good at judging whether you're better than the game. And then
Yes.
you need to also think about, if you lose too much, you're going to carry that into the next day's trading, and you're going to be trying to chase those losses. So you only ever want to lose an amount of money where you can come in the next day and feel like you get that big reset. We all feel different when we come in the next morning, right? So you want to make sure that you have that big reset. So, like, that's why those loss limits are really important, because then you can say, what I want to make sure that I'm only ever losing an amount where the next morning I can come in at a reset. And then you can set another rule, which is, if I lose more than that, I've got to take a couple days off. because otherwise I'm not going to have that reset, and that reset's really important. So we can start to get to those things, right? If I'm sick, I'm not going to trade. If I lose a certain amount of money, I'm going to stop. If I'm in a fight with my spouse, I shouldn't be trading. If and that's what we're getting through that negative thinking. We're just sort of thinking about all those ways that things can go wrong. And you just talked about through the journaling exercise, you can start to sort of spot those things for yourself. What are your Achilles heels that are going to really negatively impact your trading? Because the thing is, it's sort of going back to that. You may be very good, and you may really make great decisions. But when we're talking about things where you're trading against other experts, when you lose that tiny little bit of edge, that can be everything.
Everything. Yeah, I mean, and for me, so much of what you said is things that I've learned over the years, and I've also put into play to where I don't have trading rules. And I know some people are like, he doesn't have trading rules. I have rules for my strategy. But what I learned was that in the heat of the moment, I need to have instincts. So a big thing like this past couple of weeks, I had a couple of days where my instincts failed me by knowing when to stop. One of my instincts is know when to stop. I didn't get enough sleep, and it's amazing how I knew it when I woke up. I had that cup of coffee, I didn't eat too much, and I was a little bit more kind of amped up than normal. And that caused me to take all that good homework I did and lose money. And I look back and go, once again, man, it's an instinct. At the moment, you didn't make it, and it's like I don't. That's why I don't like to have rules. I think that over time, as I've journaled and just journaled myself and everything that I've gone through in my experiences when I was trading, that I've developed instincts, and that's just been so important to me. Just to be able to make those moments, make those decisions in the heat of the moment. Now, final question today before I let you go. One of my favorite parts of How to Decide in the book is the 3 Ps. Talk to us about that.
Yeah. So when you make a decision, you're really making a prediction of the future. That's really what it is, right? You're saying that like if I do this, I think that things are going to go better for me than if I do this other thing. And one of the things that I'm really a big fan of is understanding that there's certain decisions that you're going to have to make like in the moment. But what you want to do is then go back and examine those so that you can start to reinforce really good habits when you do have to sort of be on your feet and think. Um, that's why I love to think about what are the sort of restrictions that I can put on myself in the future to sort of discipline my instinct to make my instinct better, right? So the 3 Ps is one of the ways to do that is to really understand that when you're making a decision, when you're considering a particular option that you want to choose, you have to think about 3 things. One is what are the reasonable possible ways that it could turn out? And you could think about that as bins, right? You could think about you know, losing 5%, losing 10%, breaking even, winning 5%, winning 10%, whatever, right? You could think about forecasting strike prices, for example, right? Like you figure out what is the thing that I really care about. You figure out what the sort of reasonable ranges of those things are, like, you know, from bad to good, and you sort of map out what those are. So that's the possibilities. That's the first P. Obviously, then you want to think about what the payoffs are. The more that one of those advances you toward your goal or helps you make money, you're going to prefer that more than things that cause you to retreat away. So now you've sort of mapped out for yourself, here are what the possibilities are, and here are the payoffs for each of those possibilities. And then this is a super important step. You must assign a probability to each of those bins. You have to. And I think that what happens with a lot of people is that they say, well, my gut's just telling me this. And it's like, but the problem is that your gut might be pretty good, but sometimes it's not. And if you don't actually take the time to start thinking about, well, what are the probabilities of each of these things happening? Then you can't go back and check on your decision process. You have no way to go back and look because you didn't actually sort of like record what your thoughts were. And in sort of forcing yourself to map this stuff out and think about what the probabilities of those different outcomes are, a whole bunch of good stuff comes from it. Mainly, you'll generally start to go look at what the base rates are. And we really care about what base rates are. We want to know, in market terms, we want to know what beta is. And if you don't know that, it's very hard for you to think about what the quality of your decisions are. I mean, just as an example, you may be winning, but you could be coming in below what you would be doing if you were passive and still be winning, because we know that passive investment strategies really make a lot of money. So you need to be always thinking about what those benchmarks are. So you know what you're benchmarking to. And unless you're thinking about the probability of any outcome occurring, you're not actually going to be you're not going to be really searching for those benchmarks. You're not going to be eager to go find them. The other thing that's going to happen is that if you don't do that, you haven't kind of set for yourself what an expectation is for that type of trade. And as you kind of accumulate enough data, now what's going to happen, because you don't have that expectation recorded, is that you're going to tend to linger on your bad results. But the thing is that some bad results would be expected, right? I mean, that's sort of the whole thing. There's
Yeah.
volatility. So when you actually go through the three Ps and you say, here's sort of the set of possible outcomes, and here's the payoffs for those, and here's how probable I think that any of those are. Now, once you sort of collect enough data, you can figure out if it's unexpected. Whether it's unexpected on the high side or the low side, you don't care, because over allocation and under allocation are both equally bad problems. You wouldn't want to do either of those. So that actually goes back to helping you with that original problem that we talked about, which is what are the ways that we're thinking about outcomes? And you should stop thinking about wins and losses, and you should start thinking about expectation and just compare it to expectation. And if it comes up way above expectation, you need to explore that just as much. Is my model wrong? Is there more risk in this trade than I actually thought there was? Did I win for a reason that had nothing to do with the reasons that I thought I would win? Is this repeatable? Should I start allocating more money to this strategy? All of those things. And you can only do that if you set up the three Ps in the first place.
Annie, I could talk to you all day, but we're out of time. Everybody get this book. It is unbelievable. Annie, thank you so much for joining me today.
Thank you.
All right, traders, hang tight. I'll be right back with my final thoughts.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Why trade with Tradestation? It's innovative, easy to use, and totally freaking sweet. With powerful tools to track and execute your trades and low per trade commissions on stocks, futures, and options. Upgrade your trade at Tradestation.com.
Final thoughts for today, traders. I talk about mental edge all the time on this show and on social media because to me, it's the most important part of my trading journey. Becoming the trader I wanted to be was not about the charts, was not about the fundamentals. Really, anybody can learn charts. Anybody can learn fundamentals. But to think like a trader, to make good decisions in the heat of the moment, that comes down to mental edge. And I'm so thankful for Annie Duke coming on the show. I love your books, Annie. Everybody check out her books. They're fantastic. I've learned so much from her over the years through her books, and to have her on the show today was just awesome. So thanks again, Annie, for coming on the show. Now, before I let you guys go, probably a lot of new traders watching this show, hopefully getting more and more people active and involved in trading futures. Go to activetrader.cmegroup.com. Pretty much everything that you want to learn about futures will be there. So be sure to check out activetrader.cmegroup.com. And remember, traders, if you have any questions or comments, please put them down below. You could also follow me on Twitter at Anthony Crudele and check out Instagram, Anthony C. Crudele. That's a wrap for today. See you next week.